Hey everyone, in today's video, I'm going to talk about the three ETFs that I would invest in as a complete beginner if I were to start over in my 20s. And I know that everyone has busy schedules, so I'm just going to tell you what these three ETFs are. The first is SPY, second is QQQ, and the third is SCHD. I'll also talk about why I'm investing in these ETFs and talk about the specific details of each of these funds. A lot of you know that I'm a little bit more on the conservative side when it comes to investing. I don't like to invest in these high risk assets. I do like to diversify my portfolio just in case something happens in the stock market. Because I'm sharing this with all of you, I don't want you guys to just buy these ETFs because I'm buying them. These are the ETFs that I'm comfortable with investing in. You have to see if these ETFs are good for your portfolio and if it fits your risk tolerance. But essentially, it comes down to these three categories. I like to invest in ETFs that track first, the S&P 500. The second ETF, I like it to track the NASDAQ 100 or the top 100 technology companies in the United States. And the third ETF is some sort of dividend-paying ETF. It's a little bit more on the boring side, but I do like getting paid dividends on a quarterly basis. Now, just to give you an update with my portfolio. It's currently around a million, 1.09 million right now. It just reached another all-time high because the stock market has been going up. And my goal for this specific account is to reach $2 million within hopefully the next 5 or 6, 7 years or so. Okay, so let's talk about the very first ETF, which is an S&P 500 ETF. For me personally, I like to invest in SPY. There are a lot of different alternatives out there. For example, there's IVV, there's FXAIX, there's VOO, and really they all pretty much do the same thing. They track the S&P 500 or the top 500 companies in the United States. For me, I chose SPY because I like to sell cover calls. A lot of the contracts for SPY are more liquid, which is easier for me to sell these cover call contracts to other people. But if you're a long-term investor, you don't really care about selling cover calls, you can just opt in for VOO, FXAIX, or even IVV. But for me, I like SPY. You can choose whatever you're most comfortable with. And this is pretty much the performance of the ETF over the past several years. If we take a look at the breakdown of this ETF, you can see that around the top 34% of the holdings within this fund is on Microsoft, Apple, Nvidia, Amazon, Facebook, Meta, Google, so on and so forth, right? And if we look at the sector weightings, around 31% of the companies within this fund is in technology, 12% in financial services, another 12% in healthcare, and 10% in consumer cyclicals. And how well has the S&P 500 performed over the past several years? 10 years, 50 years, 100 years, 150 years? Well, here is the data. Typically, the S&P 500 grows around 7 to 12% on average per year. Now, why is this such a big range, 7 to 12? Well, it depends on how you look at it, right? It depends on the time frame. It depends on if you reinvest dividends. So let's talk about these numbers in detail because I do know that a lot of people get kind of confused on what this actually means. So if we take a look at the past 150 years, the stock market has returned around 9.28% if you were to reinvest dividends, if you turn on the drip function in your brokerage. If you take a look at the past 100 years, that's around 10%. And if you get closer to just the past recent years, we've been getting around 12 to 13% returns if we were to reinvest dividends. Now, if we were to adjust this with inflation, then of course this number is going to be quote unquote lower. It's going to be around 7%. That's why I made the lower range around 7%. And I made the higher range around like 12% or something, right? And if you take a look at the past 5 to 10 years, we've been getting an average of around 9.5, 10%. I know there is this whole talk about inflation. However, when we are investing, we're not just going to be investing the same amount of money into our brokerage accounts. I know a lot of times when I talk about investing in a Roth IRA, we want to deposit around $583 per month, right? Or $7,000, which is the contribution limit for 2024. And I divide that by 12, that's around $583. But if you really think about it, later in life, maybe in the next 3 years, 5 years, 7 years, 10 years, 20 years, that contribution limit is going to increase. And this means that as you get older, typically with your income, it is also going to increase, meaning that you are going to be depositing more money into your accounts, which means that you are increasing your income along with inflation, and hopefully even more than inflation. All right. So typically when I look at these stock market returns, I focus on this column right here. I don't really adjust it for inflation because my income is going to be increasing and my contributions are also going to be adjusted with inflation too. Hopefully that mathematically makes sense. Now, the second ETF is an ETF that tracks the NASDAQ 100. For me, I like QQQ. Again, there are a lot of different alternatives. With QQQ, it is more on the volatile side, okay? It is very technology heavy, which I'll show you in a little bit, but we've had amazing returns over the past several years. Remember with QQQ, the dividend yield for this fund is relatively low. It's around 0.58%. I don't know if you can see it on the bottom right here. So for you to get dividends from this fund, it's going to be small compared to the S&P 500 fund, SPY, or even SCHD, which I'll talk about in a little bit. If we kind of look at the top 10 holdings, you can see that, again, very similarly to S&P 500 funds, Microsoft, Apple, Nvidia, Amazon, Meta, right? All of these companies, technology companies, are within this fund. However, the big difference is majority of the companies that make up this fund is around 48 to 50%. This is compared to the 30% that we saw in the S&P 500. And if we look at the sector weightings, again, 50% is in technology, 15% in communication services, and 12% in consumer cyclicals. Now, how well has this fund done over the past several years? Well, if you take a look at how it's done over the past 5 years, we've been getting around like 21% returns, and in the last 10 years, 18%. This is compared to around what, 10%, 12% in the S&P 500. Just because I'm sharing this with you all doesn't mean that we're all going to buy QQQ, or I'm going to buy all QQQ if I were to start over, because we must remember that with technology companies, there is more volatility. So if we encounter some sort of pullback, correction, then usually, not always, usually these technology companies are the ones that pull back or drop the fastest during times of uncertainty compared to these other companies, these other stable companies, which I'll talk about in SCHD. So if you have the risk tolerance of huge fluctuations in your portfolio, then QQQ might be good for you. But for me, if I were to start over as a 20-year-old and I'm investing for the long term, I would probably have more technology companies in my portfolio because I'm investing for the next 20, 30, 40 years or so. And as I get closer to my retirement, then I might kind of lay off the technology and maybe invest in more of these dividend-paying assets, which again, I'll talk about for SCHD. Okay, so here is the third ETF, SCHD, which tracks a lot of these Dow 30 components, these companies that have been around for a very long time that pay some sort of dividend. They're more on the stable, steady side. If you take a look at the dividend yield, instead of 0.5%, 0.58%, which we saw in QQQ, the dividend yield is 3.4%, which you can see on the bottom right here, right? Again, I like getting paid dividends on a quarterly basis. This is what I like. If we were to look at the top 10 holdings, you can see that it's very different compared to the S&P 500 and QQQ. We have Texas Instruments, Lockheed Martin, Chevron, Coca-Cola, Pepsi. The sector weighting is, again, very different. It's not full of tech. Of course, there is technology, but that's only 9.26% of this fund. Majority of this fund is in financial services, healthcare, consumer defensive, and industrials. Also with SCHD, because it has a lot of dividend-paying components, companies, during times of uncertainty, a lot of these technology companies will sell off. However, with these dividend-paying assets, a lot of institutions like to hold onto them during times of uncertainty because they have an incentive of doing so. They want to still hold onto things that will pay them on a quarterly or monthly basis, even when the stock market is going down, which is why you'll see that when we get to a time of a correction, pullback, SCHD is not going to drop as fast compared to the S&P 500 and QQQ. Usually, not always. If you guys found a lot of value in this video, feel free to support my channel. You can give me a like and subscribe. I am also going to be hosting a beginner's investing masterclass for those of you who don't know how to get started with investing. You don't know how to open up a Roth IRA, how much to invest, what to invest in. I'll leave a link down below if you guys want to join my next beginner's investing class. Okay, you guys have a wonderful day, and I will see you all in the next video. Bye, everyone.